What's going on, you guys? My name is Zach Hartley, and in this video I want to share with you 3 different ways that you can invest into real estate without having to save up and buy a property, and with very little money up front. Here is everything you need to know. Let's go. Okay, so here are the 3 strategies that we're going to talk about in this video. I will put timestamps down below in case you're already familiar with one and you just want to skip through, but these are the 3 that we are going to be going through today, starting with online crowdfunding. Now, this is kind of a newer way to invest in real estate, at least over the last few years. And basically what's happening here is these platforms are gathering money from lots of different investors. That's why it's called crowdfunding. Usually there's hundreds or thousands of different investors that are pooling their money together, and then the platform or the company is going out and investing that money into properties in order to generate a return on that investment for investors. Now, most of these deals are very long term. They're invested into actual individual buildings or projects, and they're actually really cool. So in Canada, there's one platform called Addy that is doing a really good job of this. I've invested through them, and I'm going to share with you my investments right now. And if you are in the US or you want to at least invest in US properties, I would go through Fundrise or CrowdStreet. Those seem to be the 2 kind of largest and most credible platforms in the US. Now, here's what my Addy portfolio looks like. So here's the dashboard. I've only put $500 in so far. I actually just got started here, and I actually just got $25 back by using Brandon Beavis's referral code, and now I have a referral code that will give you $25 back. It is in the description to this video, and it's really nice because it's literally free money. So I put in $500, and now my portfolio, I invested about $250 into 2 different properties here. And so here are the different investments. So a 7288 Maple Street in Mission, BC, as well as 2 Green Tree Court in Toronto. And if you look at this, they're actually listed here, and so you can see the properties. You can see exactly what they look like. This is actually a 3-building complex with like 115 units in it, and you can invest directly into this. And I only put $250 in so far. I might top that up here in a little while. And here's the second one. This one is in BC, and I believe this is actually a new construction project. They're building this right now, and they're so here you go. You can see construction updates as they kind of progress, and it's actually a really cool concept. So I put about $250 into each of these. I'm going to put a little bit more money into the account. Really easy to use, really nice. All you have to do is kind of set up an account and verify yourself, and then when your money gets deposited, that's when you get the $25 completely free. It just gets added into your account, and you can invest it into whatever property you want. The link for all of that is down below. Now, what are the positives and the negatives of doing the crowdfunding strategy here? Well, the positives are that you can invest with very little money, as you saw there. I only started with about $500, and I actually invested into 2 different properties, which is kind of cool. It was also very easy to set up, and like I said, they gave me $25 of free money to invest, which is just kind of worth the sign up regardless here, because it's $25 that I don't have to worry about, I don't have to work for, and it's completely free. Now, the drawbacks to the crowdfunding here is that you have no liquidity. You can't really sell it. There's no real market that you can sell what you bought it on, and so it's definitely a long-term investment where you're looking for cash flow on that project, depending on how it's set up. But basically, you don't really have any liquidity, and so once you put that money in, you're not really going to get it out until they sell the property, they liquidate, or they give you your money back. And so definitely something to keep in mind. You also have no control over the project. So it's not like you're going in there and saying, hey, we should renovate or we should paint the outside. You don't really have that kind of say when you make an investment like this. Now, the second strategy here is REITs, and REITs stand for Real Estate Investment Trust. And basically what a REIT is they're a publicly traded company. So they have stock. You can go into the stock market. You can buy and sell a REIT just like you buy and sell a regular share. So it's really, really nice. But because it's a REIT, there's something that's kind of unique about it. And what a REIT is they have to invest in real estate. But what's really nice about a REIT is that they pay out their distributions before paying income tax. So if you're familiar with dividends, a normal company, let's say a utility company, brings in revenue, they pay for all of their expenses, and then they have profit left over. They then get taxed on that profit. Let's say it was $100, they get taxed at 20%, they've got $80 left over, and they can give that $80 out to their shareholders in the form of dividends. A REIT is slightly different, where they have to invest in real estate and they generate income from the rental revenue coming from those properties. And so that's their income. They pay for all of their expenses. And then what's really nice about a REIT is that as soon as the expenses are paid, they can then pay out their shareholders before paying tax. And what that means is that there's more money left over to go to shareholders because they can pay that money out before they pay tax. Now, because they can do that, they have to meet certain classifications, one of them being that they only invest in real estate. And so what's really nice about a REIT is that you can buy and sell it like a stock. You know that they have direct exposure to real estate, and you can buy REITs in different types of real estate as well. And you get a big tax advantage because more of the money that the company generates can be sent out to you. When it's a REIT, it's usually called a distribution, but it's very similar to the idea of a dividend. Now, here are a couple popular REITs in Canada and the US. I believe these ones are all US and these ones are all Canada. I actually got this kind of list here from Daniel Pronk on his new Stock Unlock software. And I took a quick look at all the companies. I actually think they're all really good. And so here's a list of some popular REITs that you can look into. They actually all specialize in different things. Some of it is commercial, some of it's medical, some of it is housing, some of it is a variety of different things, and some of it's very well diversified. So definitely take a look at some of these REITs if you're looking for something that you can buy and sell very easily, that's fully liquid, that you can get in and out of if you need the money. The REITs are definitely the way to go because you can buy and sell it just like a stock. The other two options that I'm talking about today, you don't really have that ability. And so if you're looking for liquidity, REITs are definitely the best way to go. Now, here's an example of one of the REITs that I just showed you on the last page, tnt.un.to. .un right here basically stands for unit, and that means that it is a REIT. It's basically a way of classifying it. .to means that it trades on the Canadian exchange, and then TNT is the ticker symbol here. You can see that's True North Commercial Real Estate Investment Trust. And what's really nice about this company is you can buy it for $7.40 a share, and they currently have a dividend yield of 8.03%, which means that for every $100 you invest into the company, you're gonna get about 8% back per year, which realistically is really good. And compared to a dividend paying company, this is typically higher than the standard dividend that you would receive at, let's say, a utility company or a rail company or an energy company. 8% is really good, and part of that, the reason that it's so high is because of that tax advantage that I just explained to you. Now, here are the positives and the negatives behind REIT investing. Number one, the positive, so you can invest with very little money, as low as $7 to buy one of those shares, plus your commissions, and they're bought and sold like a stock, so you have full liquidity. You can literally buy and sell within a couple minutes. You liquidate your entire position, especially if you're into one of those big REITs that are popular. You got lots of liquidity there, very easy to buy and sell, and you get steady cash flow right away. You don't have to wait for the building to be constructed or for the deal to close or anything like that. You can buy it today, and if they issue a distribution in the next few months, you get it right away, which is really nice. Now, the negatives here are that you usually have a slightly lower return. The forecasted returns on Addy, for example, were anywhere from 11 to 14%. And with a REIT, you can see in a good scenario, you're getting about 8%. And again, you also have no control here. So you can't go into one of these properties and say, hey, we should do things a little bit differently. You're literally just a shareholder like everybody else. You own a couple of shares in a company that owns a bunch of properties, but you're not gonna be able to go in there and say, hey, this is how we should do things. You have no control. Now, the third strategy here is called syndicate or syndication or property syndicate, whatever you want to call it. It's all pretty much the same thing. And basically what you're doing here is you're going out and you're finding an investment property and raising money to purchase it. You're basically starting your own little kind of real estate business, and you're going out, you're finding investment opportunities, you're going out and finding investors, trying to get them to invest in that opportunity. You're executing on that opportunity. You're taking a little bit, you're giving your investors back some money, and it's kind of a unique way to do things, because if you can find a good enough deal and you can structure it properly, you might not even have to invest anything other than your time and your effort up front. And so here's an example of how this could work. Number one, you have to find a property. This is probably the hardest part of it. This is going to take the most work here, and this is going to be the real challenge here, is find a good property that generates a good cash flow and ROI. So basically, we're looking for a rental property. It could be commercial, it could be a housing complex, it could be anything you want it to be. It just has to generate good cash flow and good return on your investment. Now, once you have that property and you've had some conversations and they're ready to go with you, you need to put together a deal. You need to put together a PowerPoint with photos of the property, what it looks like, what it has, what it can offer, what the tenants look like, and you need to put together the deal terms with forecasted cash flow. So for instance, if you think the property's $500,000 and it's going to generate $35,000 per year, and after expenses it's $28,000, how much are the investors going to get back? What happens if you don't have all of that vacancy? You need to put together all of these different scenarios and factors. If you need help with that, definitely check out some videos on YouTube. And then once you have that deal, once you can say, hey, I got this property, this is what the investment is, this is what the ROI looks like, this is what the best case scenario is, and here are the terms of the deal. Once you have all of that figured out, you need to go out and you need to find investors that can write checks to fund the purchase in return for cash flow from that property. Now, if I were gonna do this, I would go to LinkedIn and I would find everybody in my area that says property investor on their LinkedIn profile. I would message them up and I would see if they're interested. And not only that, but if you can find a good enough deal, I will put my email in the description to this video. You can send it to me and I will even write you a check. It should not be hard to find investors if you can put together a good deal, because investors that have a good deal usually like to send it to their friends. So if you can find a couple of people that believe in what you're doing, you should be able to spread the word pretty quickly. I would start with LinkedIn. I would start with your network. I would start by sending it to me and I'll share it around. And there's a couple different ways to do it, but use your network, use LinkedIn, use social media, and try and get that deal that you've put together out into the world so that you can raise the money, buy the property, renovate it, or do whatever you need to do to fix it up and get it going, and then start executing on the strategy and the plan and start giving that money back to your investors. Now, the positives of this scenario and this strategy are that you have full control here and you may not even need any money to get started. If you can find a good enough deal with enough investors, you might not even need to put up any of your own money to get started. You can just take a performance fee, a sponsor fee, or any of the extra income on top of the preferred. So lots of opportunity there, lots of ways to make money, and you might not even need to fund it yourself, and you have the ability to generate additional and steady income. Now, the downside here, so this is going to take a whole lot of work. It's not going to be easy to do. You need to find a good deal first, and you're putting your reputation on the line. If you go out and go to your network and say, hey, I got this deal, I want to buy this property, you take money from your friends and family and the deal doesn't work out, you've just shot your reputation. So you need to be very, very careful with that, and you need to be very, very sure of the deal that you are offering to people, because this can be kind of messy if it doesn't work out. So you need to be very careful here. Now, if you're interested in learning about how to invest your money, especially in the stock market or in buying those REITs, then definitely consider checking out my course on the stock market fundamentals. It is completely free and you get 2 weeks to 1 month completely free when you sign up with the link in the description to this video. That will take you to Skillshare, where you can take my course. It's 10 hours long. There's over 11,000 students that have taken the course. There's 380 reviews and 1.6 million minutes of watch time, and it will walk you through everything you need to know about getting started in the stock market the right way. And we'll also walk you through how to buy those REITs. So if you're interested in going down that pathway and you like the liquidity of the REITs, definitely consider checking out this course, because it will give you everything you need to get started. The link is down below. 1 month completely free. Cancel your subscription after that. You won't pay a dime. It's 2 weeks depending on what country you live in, but Canada and the US, it's 1 month right now. So definitely check it out. Promise it will be well worth the effort, well worth your time. It'll be the best free resource that you can find online. Now, good luck trading, good luck investing, and we'll see you guys in the next video.